What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be covering in this update video is we're going to be taking a little bit of a look at the price action we saw today, the Ortex data, and some of the key developments that we've seen kind of develop over the last week or so. We're going to be taking a look at the option chain going into the end of this week, and the most important option chain, that expiration date that I've been talking about for a while, that January monthly options chain, to just kind of see how it's developing. The max pain. We have a new kind of automatic margin call rule with the Fixed Income Clearing Corporation, and that is really going to have to do with bonds. Bonds are fixed income. And then we have to talk about this very interesting situation that we have been kind of going over on this channel over the last couple of weekends. Essentially, this situation with the amount of derivatives exposure that is outstanding in the current marketplace. Now, we have been looking previously at the second quarter data, but actually yesterday we were able to get the third quarter data. Now, there's something that happened in the third quarter that really made the data that we are seeing right now a lot different. And it is very, very important, especially with the current marketplace that we are in right now, with all of the massive amounts of over leveraging that we've seen over the last 2 years. These new proposed rule changes have started to make a difference, and I'm going to show you guys exactly how and how this is going to affect AMC and all of these other short squeeze plays that we have going forward. So before we get into all of that information, if you enjoy the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So AMC closed the day today at $30.30, up about 2%. And right now it's down in the after hours about 0.43%. Remember, we are getting BlackBerry's earnings after hours today. So if we see a situation similar to what we saw with Bed Bath & Beyond, it is possible that AMC and GME could go on a run in the after hours, but we're just going to have to wait and see. So again, when we take a look at the actual chart of AMC today, there's a couple of candles that really stick out at me. This one right here, we saw a wild move in the overall market, really without any news. This kind of just goes to show us just how much control these algorithms and big money have in our overall market. If the overall market is going to start selling off in a very significant way, a lot of other stocks are going to go with it. So the way our market is currently set up right now is really not meant for retail investors, but more towards these institutions, which is really something we all should know by now. Now, coming over to the Ortex data here, we have utilization still above 80 at 81.34%. We have that current estimated short interest of the free float number down slightly today at 20.13%, but there was a little bit more action in the securities lending market today for AMC. So return shares, 3.76 million, borrowed shares, 2.98 million. So there was a net return of shares on AMC today of about 779,000. But something interesting here is the cost to borrow max, the maximum cost to borrow to take out a loan of AMC shares, has started to step up a little bit, 14.13%. That's not something we have seen in a very long time, and it may have something to do with the utilization climbing back up. If there is scarcity for shares to go out on loan, these cost to borrow numbers are going to start to go back up, which is why we focus on that utilization number so much. Now, the average days on loan over here, we are seeing it to climb back up a little bit. But again, with the amount of shorting that's happened on AMC over the last 2 weeks, the danger zone is still a lot lower, and you can't really change that. It's kind of something that after it happens, it's going to be very, very difficult to change unless they start covering these positions. And again, days to cover still at 2.46 days, which is still going to make it very, very difficult for these shorts to get out of their positions in terms of the amount of volume in the stock. And today, we only saw a volume of about 46.5 million, and we still increased by about 2%. Now, coming over to the option chain for AMC, let me give this a quick refresh. So for this week, we have 38,000 call contracts in the money, and for puts, we have 7,205 contracts in the money. So if we were to see any delta hedging and any effect of that delta hedging, it would be more towards the buying demand side. But again, there's not really enough calls in the money right now to really send this back up. But for this January expiration date, we are seeing the calls start to trickle in. We now have 127,000 contracts in the money since we are now above 30 and 412,000 contracts out of the money. Over this week, we are going to see this option chain really start to heat up, and that is going to be something that we really need to watch out for, because every single time we've seen a really big run up on AMC, we have always seen the options chain look a little bit dangerous for a lot of these option sellers and market makers who are selling these options to institutions and retail investors. Now, the max pain for this week, speaking about options, is $28 a share. That is going to be the price that the most amount of options contracts expire out of the money on the put and the call side. As more people start to buy calls, that max pain price, especially calls that are closer to the money, that max pain price is going to start to decrease. So let's get into this first automatic margin call rule and these new liquidity requirements that you guys showed me on stream this morning, which thank you guys for that, sourcing that information. That's exactly what we need to be doing. So right here, Gov 1201-21, December 16th, 2021. So we see here the Fixed Income Clearing Corporation's Government Securities Division will reset each netting member's individual total amount. I believe that's the cap contingency liquidity facility cap on January 3rd, 2022. The reset will reflect a look-back period of July 1st to December 31st of this year. The new CCLF cap will be effective as of January 3rd, 2022. Now, when we see here, as reflected in the officer's certificate, each member has certified, among other things, that it will incorporate any change to its individual total amount into its liquidity planning, and it will, through periodic discussions with its financing sources and other methods, continually reassess its liquidity plans and related operational plans and procedures, including in the event of any changes to the member's CCLF cap, to ensure its ability to meet any funding obligations incurred as a result of the FICC, the Fixed Income Clearing Corporation's declaration of one of these events. Essentially, what is happening here is they're going to be daily check-ins with these liquidity requirements for these institutions trading in fixed income. If they are outside of these requirements, then they are going to have to reset themselves, essentially a margin call. Now, getting into this other situation with this Goldman Sachs margin call, there is something that we need to talk about before we really get into the rest of this information, so it kind of all makes a lot of sense. So remember how the quarters of the year work. We're going to have January, February, March, April, May, June, and then July, August, and September. Now, that third quarter is very important for what we're looking at right here. During his opening remarks, DTCC's Bob Stewart, Executive Director in Product Management for Institutional Trade Processing, discussed the impact of Phase 5 uncleared margin rules for over-the-counter derivatives, which kicks in on September 1st, 2021. Quote, there will be an upsurge in the volume, basically the frequency of margin calls, and an increase in the need for third-party custodians to keep safe collateral. As a result, UMR will likely require many buy-side firms to make significant changes to their existing collateral management processes. So what they're saying here is there's going to be a lot more margin calls. They're tightening up in the derivatives market in how these institutions are levering up. Now, we have gone over the Office of the Comptroller of the Currency's report from the second quarter, and we've just been waiting on that third quarter report. But the third quarter report is going to include this September 1st date once we are going to see this increase in the volume of margin calls. Remember, the institution that stuck out to us the most was Goldman Sachs with a leverage ratio of 133-1. To put that into perspective, Lehman Brothers leverage ratio, well, right before they collapsed in 2008, was about 40-45-1. So they were levered up a crazy amount. Now, when we come over to the actual report here, we can see JP Morgan is at the top. Citigroup actually came ahead of Goldman Sachs, but now we are seeing Goldman's ratio, their leverage ratio on these derivatives. We can see here total assets, total derivatives, a lot lower. Now, when we scroll down to the very bottom, we see $242 trillion in total derivatives exposure. Remember, this is in millions of the top 25 commercial banks. When we come over to what it was in Q2, $183 trillion. And then we see right here, Goldman Sachs had total assets right here of, I believe, $351 billion would be that number, and total derivatives of $47 trillion of exposure. And most of these are concentrated over-the-counter swaps. So these OTC derivatives are going to fall under that phase 5 UMR. Remember back in Q2 when Goldman Sachs came out in its earnings report and said that they were selling off about 25% of all of their equity holdings, and they were kind of citing fears going into the fourth quarter about debt ceiling and a lot of these other things. But when you think about the fears over the debt ceiling, these fears come up all the time. So Goldman Sachs, knowing this, wouldn't really need to be all that scared about these debt ceiling conversations. So why were they basically clearing out a lot of this capital? This is why right here, the assets right here, we can see that the total asset number, let's just say it's 351,000, just so we can make these numbers a little bit easier. They have jumped up all the way to about 1.4 million. This is absolutely insane, and they've also decreased their total derivatives position. This suggests that phase 5 UMR is kicked in, and Goldman Sachs and a lot of these other institutions have been margin called. When you go through this list, the leverage ratios of a lot of these institutions is a lot lower. Now, how does this really play into this AMC situation that we've been looking at here? Well, one, we are seeing the total amount of derivatives exposure increase, but they are not as much, they aren't as highly levered up, meaning that there's not as much risk anymore in these derivatives positions going into the end of the year. The second thing, though, is that since these institutions need to put up a lot more collateral, they may not want to do this. And when you think about how a lot of these stocks, these quote meme stocks, are linked, it seems that they are linked through the swap market in a lot of these over-the-counter derivatives. So they may not be able to create as much synthetic short interest or hide a lot of this short interest in these swap contracts as they were able to before. Now, the actual amount that we're seeing on the derivatives exposure right here, it's not good. When we take a look at what exactly it was back in 2008, it was about 187 trillion, I believe, and right now we're sitting at 242 trillion. So it's a lot more than 2008. When you account for inflation, we're probably still not there yet, but this isn't necessarily the best thing to be seeing in our markets with our large commercial banking institutions messing around with these derivatives contracts with crazy high amounts of leverage. So that is mainly going to wrap up this update on AMC and the whole derivative situation that we have been looking for and looking at over the last couple of weeks. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening, and I'll see you guys in the next video.